So imagine we have a portfolio of 4 stocks and we want to determine the weight of each stock within our portfolio. We can quickly do that in Python. So the easiest way to do that is to do it in Python, where we import some packages and we use those packages to determine the weight of each stock within our portfolio. So the first thing we want to do here quickly is just to import some packages. So we're going to import NumPy as NP. And then we can import pandas. Be real quick. As PD. Import matplotlib.pyplot. For our visuals, we use the alias POT. We can also import yfinance as YF, and then let us display each chart within each code block. So we use %matplotlib. Display each chart within each line of each code. So we use %matplotlib in line, and we have that in place there. So I haven't done that. The next thing we want to do here is to define our stock list. So the list of stocks within our portfolio. Let us create a list for that. We will begin with Apple stocks, APL, that's the ticker Apple trades with on the NASDAQ. We go to Microsoft and SFT. We can also introduce within our portfolio. In this case, we would take AMD, and also lastly, Oracle stocks. So we have that in place there. We can also run that code block. So having done that, the next thing we want to do here is to download these stocks from Yahoo Finance. So in order to do that, we will just quickly say stock data frame df should be equal to yfinance.download. And in this case, we want to download all of the stocks within our stock list. So we have that in place. Then the start date. Let us begin from the year. Let's go back as far as 2023, end of that year, and then the end date. Let us 2025, the start of that year. So we have that in place there. So So having that in place, let us just make sure that we are referring to stock returns. So we print the first few rows of the stock returns. As you can see that we have the daily stock returns of each stock within our portfolio. We have a portfolio of 4 stocks. And here we want to optimize the portfolio by determining the weight of each stock. Like we have a $10,000 investment value. We want to know how much returns at the given level of risks we should invest in each of these stocks. So which of these stocks will take the greatest portion of our investment value? So if we are investing 50% in Apple stock, why are we investing 50% in Apple stock? That will be based on the risk adjusted returns. That's exactly what we are seeing here. So the highest returns at every given level of risk will determine how much we'll be allocating for each stock within our portfolio. So this is exactly what investment and management firms do in managing your portfolio for you. So here, let us now come up here with the weight. So we will determine our weight array here. Weight array in this case to be equal to, we're gonna use the numpy.zeros function, because essentially what we are doing here is we are creating an array of 4 stocks and filling that array with zeros. The reason why we are doing that is because we will later on use this array to fill this array with random numbers generated from our random function. So essentially that's what we're trying to do here. So we want to create an array of 10,000 rows and 4 columns. So we would define that. But then before we do that, so we create an array of 4 stocks within our portfolio. So we have 4 columns with 10,000 rows. So before we do that, we can define our simulations here. So we will go by simulations to be equal to 10,000. So we're going to be running 10,000 different simulations to determine our returns array, volatility array, Sharpe ratio array, and also our weight array. For the weight array, we will have 10,000 rows with 4 columns. So here for the argument here is going to be simulations, and also here we will return the 4 columns by using the len function, and then we'll go by stock returns. We introduce that, and we return the columns by going by dot columns. So we have that in place there. So we can run that code block. And now if we define the weight array, we can see that we have 4 rows, we have 4 columns, and 10,000 rows. So we're going to be filling this later one with numbers, with random numbers from the normal random function. So we can also weight array just to show you. Let us visualize the shape. As you can see, we have 10,000 rows and 4 columns here. And then we can do the same thing for returns array. In this case, it's going to be numpy.zeros simulations. So we just have 10,000 rows. You can copy this and paste it for the volatility array and also our Sharpe array. So let's just edit to be volatility. And let us edit this to be Sharpe array. As you can see, if we run this, returns just one of those. To run that using returns array.shape, you can see that we just have 10,000 rows there. So having done that, it is very, very important for us to understand that to determine the volatility of our portfolio for n stocks in our portfolio, that is for n stocks within our portfolio, we will have to use the metrics to determine that. So in order to do that, we will have to take into account the returns of each stock within the portfolio. We use those returns and determine the covariance of those returns, and then we will assign the weights to those returns, and we multiply that by our metrics of our weights of each stock within the portfolio. So that's essentially what we're gonna be doing here. So for the volatility array, to determine the volatility array of each simulation, we're gonna be using that concept. We're gonna be applying that concept which you just mentioned. So we're gonna be applying that concept which I just mentioned. It's very important for us to understand that. And for two stocks within the portfolio, if we had just two stocks in our portfolio, then we would just use the normal algorithm in finance, in modern finance, where we take into account the weight of each stock. That is, let's just say we have stocks A and B. We would take the weight of A squared, multiply it by the standard deviation of A squared, plus the weight of B squared, that is stock B, and multiply that by the standard deviation of B squared, and then we go again plus 2 times the weight of A times the standard deviation of B plus the weight of B times the standard deviation of A, and then we now apply correlation between those two stocks. Take the square root of everything. Essentially, that's how we determine the standard deviation of our portfolio. The square root of standard deviation, the reason why we apply the square root, it is because we want to convert that to percent so that it is easily, it can be easily applied in the real world. So that's essentially what we do for two. Take the return of portfolio. So the next thing we want to do here is to import random, and then we will go by random.seed. The reason why we use random.seed here is because it is for reproducibility. So if we're going to be using this model in production, they will have to come back to delete this line of code. However, going forward, we don't want to run this code each time we have different random numbers being calculated in the model and producing different results. We just want the same result each time we run the code. So that is why we use the random.seed. And then we can also just numpy dot random.seed. We have that in place there. So now we want to the next thing we want to do here is just to come up with some, define our numbers. So in this case, the numbers is going to be equal to numpy.array. So we want to come up with a set of random numbers. So we use the numpy.array, and then we go again numpy.random. So we want a set of four random numbers, and then we want to take the weight of each random number. So in order to do that, so I could just go print numbers so we can visualize that. As you can see there, we have four random numbers, and then we want to take the weight. So if I go by weight of each number, so we will just go by take numbers and divide that by numpy dot sum of all those numbers. And if you print that, print weight, as you can see, we have four random numbers and we have the weight applied to each number. So I'm just going to delete this. This was just to show you that we are going to be coming up with four random numbers. These four random numbers, we will use these numbers and we will calculate the weight as we have just done here. We use this weight to fill this our weight array, which we set up a while ago here with zeros. So we're going to be using these numbers to fill these zeros with numbers. So that's essentially what we're going to be doing here. So that's what we're doing here. So we will just delete this for now. So we have a set of four random numbers and we have the weight applied there. So now we want this 10,000 times. So we want to run these scenarios, these simulations 10,000 times, so that we can come up with the optimal weight of each stock within the portfolio. So in order to do that, we will have to go by for, we can use for I, or let's just use index, or index in range within our simulations. Set it up there. You can copy all of this. Control X that. So we have that in place there. For index in range of each simulations, we're going to be determining the numbers for each simulations and the weights for each of those simulations. So having that set up, we can now, our weight array, so our rows is our simulations, 10,000 rows here. So we go by index, since we already have that in the for loop as simulations. So the index represent each simulations. So we go by index, and then we will select all of our four columns here. So we use the column. So we have 10,000 rows and four columns. have to make sure that that is in square brackets, since that is a key. So that is going to be equal to our weights. So essentially what we are doing here is that we are filling what we have done here. So with this weight array, we are filling all of these numbers here with our weights, which we calculated here. I illustrated a while ago. We have a weight here of 4 random numbers. So we are filling this array with this weight here. So we have 10,000 simulations and we have 4 columns filled with numbers. So the next thing we want to do here is to compute. Here we're going to go by returns array, and in this case we just have here just 10,000 rows, and then we can now go by numpy.sum, and then we have our stock returns. In this case, we're going to be taking the mean of those stock returns. So we take the average, and then we multiply that by 252 trading days in the year, or we multiply that by the weight. So that's how we determine the returns of each simulation. So essentially what we are saying here is that within our 4 stocks in the portfolio, we are determining the weights. We are determining the returns each stock within our portfolio. So we are having that determining returns by taking the average and then summing all of those together, multiplying it by 250 trading days, and multiplying it by our 4 random weight numbers which we calculated. So that will give us simulation. So having determined the returns array for each simulation, we can also volatility array for each simulation. Remember the index here there will determine each simulations. So for the volatility array, we're going to use the numpy.square root. That is, we're determining the volatility based on the standard deviation. So we go by numpy.square root, like I said before. It is essentially we take numpy, I'm going to go by numpy dot, and here we have to assign our weights, and of course we have to transpose it. Then we go again by numpy dot, make sure it's lowercase, numpy dot, and then we go by the stock returns. We take the covariance of the stock returns, multiply that by 252 trading days in a year, and then we assign our weights to that, like what I said earlier before. So essentially what we are doing here is we are just taking the square root of all of this here. So the square root of the variance is the standard deviation. That's essentially what we're doing here. So when you see this numpy dot and you see this weight being transposed, it's essentially calculating the 2x2 matrix. So we're taking the weights which we had calculated earlier before, and then we are multiplying that weight being transposed by our covariance of each of our stock within our portfolio, multiplied by 252 trading days. So that's exactly what we are doing here, because we are calculating more than 2 stocks within the portfolio. If we're just calculating, or if we're just determining just two stocks within the portfolio, it was going to be just basically, like I said before, we take the square root of the weight of A squared, multiply that by the standard deviation of A plus the weight of B squared, multiply that by the standard deviation of B squared, and then we also add to that the weight of A, 2 times the weight of A, weight of B times the standard deviation of A, standard deviation of B, plus then we now introduce the correlation of the two stocks with all that square root. So that's just for determining the standard deviation of two stocks within the portfolio. But if we are going for more than two stocks, 3, 4, 5, and stocks within the portfolio, then we have to multiply that using the metrics here. So essentially, like I said before, we take the weight and we have to transpose it. We transpose the weight, which we had here. They were just 4 different random numbers. As you can see down here below, we take these numbers, we transpose it, so that it should be in the same shape as our stock returns. Remember, we had four columns of our stock returns. So we take those columns and we make sure that we transpose these weights to be the same shape as those columns, so that we can now multiply the metrics of each stock. However, the stocks, we are taking the covariance of the stocks, multiply that by 252 training days, multiply that, applying the weights to that, to use that to multiply a 2x2 matrix with our weight being transposed here. So that's essentially what we're doing here. Volatility is the most important concept in determining the return or the Sharpe ratio of our portfolio. So in this case, having determined the returns and the volatility, our Sharpe array for each simulation is going to be equal to, copy this, returns array, and just divide that by our volatility here. So ensure that in the real world, of course, we will have to apply the risk-free rate of a government bond with treasury bill. So essentially, if this if it's a 252-day, then it's gonna be the returns of a treasury bill for sure. So we're gonna be deducting the returns of a treasury bill from the returns array, and then dividing it by the volatility array, of course. But in this case, we will just let it like that, since we're just using this for demonstration. So as you can see, if we have done that right, we can run this code block by going Shift Enter. As you can see, we have that in place there. So now we can now move forward to printing this out. So we can go print. Let us print your first combination. Or permutation if it's without replacement. We can also have that. And then the first combination or permutation, we can print that by now we got the weight array. Let us print the first row, and then let's also print here the Sharpe say Sharpe ratio of the first portfolio. Let us run that code block. As you can see here, we have the first combination or permutation. If we're gonna be having this with replacement, we can see here the weights assigned to that year for each stock, and then we also have here this Sharpe ratio of the first portfolio. We can see here that it's approximately 1.36. That tells us that we can be relatively happy with the performance of our portfolio. For a Sharpe ratio greater than 1, tells us that the portfolio is performing better. So that is pretty nice to see. However, what we want to do here is, what we're interested in here is, we are interested in the allocation of the stocks of the greatest weight of our investment value. So that's what we're interested in here. So in order to determine that, we will have to now the Sharpe array calculate the max. So we can see we have the highest Sharpe ratio of 1.96. We could also just make sure, let's print that out. We have the highest Sharpe ratio of 1.96. So let us, within each simulation, let us determine among our 10,000 different simulations where the highest Sharpe ratio lies. So in order to do that, we can also go by Sharpe array. In this case, we'll go by argmax. Use the function argmax, and we can call this, let us call this index max Sharpe. So let's just print this out so it's very obvious. So if we print this out, we can see that the highest Sharpe ratio lies in approximately 6,084 row within our weight array. So we can see where the highest Sharpe ratio lies here. So according to our simulations, even if we run this again, it's going to give us the same number, since we're using the numpy.random seed, so that we can always generate the same results each time. However, if we have to use this code for production, then we'll have to delete this line of code. But we can see clearly here that our highest Sharpe ratio lies within the highest, is found within 6,084 row of our weight array. So that is very, very important to see. And let us now, in this case, let us print out here just to demonstrate which stock carries the highest Sharpe ratio. So let us print our stock list, and also let us also let us print our stock list. And now let us set up where the highest Sharpe, which stock carries the highest Sharpe ratio. So we can know the investment value that should be assigned, or we can know the greatest investment value to be allocated to that stock which carries the highest Sharpe. So in order to do that, we will have to, we have here our weights array, and then we can our series. So in the array, so having done that, we can now print. We can now print first combination or permutation if this is the replacement. We can also have that in place, and then we can also here assign here the weights array. In this case, it's just the first row, just to demonstrate the first combination. And we can also have here, we can also print here the first Sharpe ratio. Yes, Sharpe array. Let us print just the first row, just to demonstrate the first row. That is the first row. That is going to be the first simulation. But of course, we have 4 columns, so let's just demonstrate that. So for the Sharpe array, we just have remember, we just have just 10,000 different simulations. However, for the weights, we have here 10,000 rows and 4 columns. So for the first row of each stock, we're gonna see the weight. Then for the Sharpe array, we're gonna see here the highest, the first Sharpe ratio. That is for the first simulation. So if we print it out, we can see clearly here that the first Sharpe ratio is approximately 1.26, and we have our first combination or permutation of our weights here assigned for each stock. So essentially what we are seeing here is that the Sharpe ratio of 1 or greater than 1 tells us that our portfolio is performing well. So you can be relatively happy with the performance of your portfolio viewing that you have a Sharpe ratio greater than 1. Then let us investigate further. So let us go further. Let us investigate the highest Sharpe ratio within our 10,000 different simulations. As you can see, we have the highest Sharpe ratio of approximately 1.96. So our portfolio is performing very well based on 10,000 different simulations. So let us just remove that numpy.float by printing this out so you can visualize that well. As you can see, we have the highest Sharpe ratio of 1.996. So this tells us that our portfolio is performing well. So let us investigate further where we have this highest Sharpe ratio within our simulation. So remember, we have 10,000 different simulations, and we want to investigate where this highest Sharpe ratio is coming from within the simulations. So in order to do that, we'll have to go by Sharpe array again. In this case, argmax. Now let us call this index max, index max Sharpe. That is where the highest Sharpe ratio is found within our index. Remember, the index here represent each simulation. So let us run that, print that index max Sharpe. As you can see, we have it here. So where we have the highest Sharpe ratio is found in the 1,499 simulations. So in 10,000 different simulations, we have the highest Sharpe ratio is found in 1,499 row within our 10,000 different simulations. So now let us determine here. Now what we want to do here next is to determine where which stock it's being allocated the highest investment value. So suppose we have a $10,000 investment value, we will have to invest that amount of money in 4 different stocks. We want to know how much of how much of the 10,000 value will be assigning greatest in those 4 different stocks. So which of those 4 different stocks will be assigned or be allocated the highest investment values? Exactly what we want to do here. So in order to do that, to know which stock is going to be assigned the greatest investment value, so remember we have our weight array with 10,000 rows and 4 columns. So we open square brackets to include the row. In this case, we have changed that to be index mark Sharpe. So here, where this argmax function kicks in this index mark Sharpe, we'll have to use this as our row, and then we can now include all of the columns. So we have here 10,000 rows and 4 columns. So essentially what we are doing here is we are printing out the highest Sharpe ratio within our 4 stocks. So we have here the weight of the weight array of 10,000 different rows and 4 columns. And the 4 columns here are Apple stock, AMD, Microsoft, and Oracle. So just to make it clear, let us print out our stock list so you can visualize the different stocks. And we'll run the code block. As you can see, we have Apple, Microsoft, AMD, and Oracle. As you can see here, we have the array Apple stocks of approximately 61%. We have Microsoft of approximately 2%. We have AMD approximately 14% or 15%. And we have here Oracle of approximately 22%. So essentially what we are seeing here is that with our investment value of $10,000, we're going to be allocating 61% of that investment value, 61% of $10,000 into Apple stock when investing. And then we're going to be allocating 2% of that $10,000 into Microsoft. And we're going to be allocating 14% of that $10,000 investment value into AMD. And also we're going to be allocating 22% of that $10,000 investment value into Oracle. So this is essentially what happens in the investment management firm. This is what they do to allocate value in a security. So if your portfolio contains n number of stock items, this is essentially what they do. So this is how we determine the weighting of each stock within the portfolio, so that you can be very confident of how much you are allocating and how much you're getting back in returns at a given level of risk. So we call this the risk adjusted returns of our portfolio. So as you can see, it's a very powerful approach in portfolio management, where you could sit down and you make a lot of money. So by just doing this is live. This is live. This is live illustration of stocks within our portfolio. Remember, we just downloaded this directly from Yahoo Finance. So we can write here so we have here live stock illustration and portfolio optimization. So this is very pretty much this is what you see that is done in the industry, and it's very powerful to find this, doing this from your own bedroom, like very easy. So now let us print out this. Let us visualize this clearly. So we can go by PLT. Remember the matplotlib we imported as a package before, so we can go plt.figure, and then the fixed size, we can set the fixed size. Let us make the length 8 and the width 6. So we have that placed there. Just to visualize the prototype itself, so now we can go .scan. Then so we can also set this. Let us set the color bar, plt.color bar, and let us label that to be equal to Sharpe ratio. Then we have the plt.title. Portfolio optimization. Then here we have plt.x-axis. There's plt.x level. Let's name that volatility. There. Let's copy that and paste for plt.y level. And let us name this return. Let's change this to y level. And now plt.show, just to demonstrate that. Shift enter, and we run the code block. So look at this. As you can see here, we have 10,000 different simulations of each stock within the portfolio. And where you see this color fading out, it tells you that we are moving from the lowest Sharpe ratio to the highest Sharpe ratio. Now let us visualize where we can find the highest Sharpe ratio of our returns and our volatility, where the highest Sharpe ratio lies, just as we did before with our weights array. So remember here we had here where the highest Sharpe ratio lied within our weights array. As you can see, we saw that the highest Sharpe ratio was found in the Apple stock, and that's where we allocated 61% of the investment value to Apple. Now let us visualize where the highest Sharpe ratio lies within our returns and volatility array. So we're gonna call this, we can call this we can call this max Sharpe return. So it's gonna be returns array index max where the highest Sharpe ratio lies, and then we can do the same for the volatility. Copy that, paste it for the volatility. Let's call this volatility. Call this volatility here. You can run that code block. So we want to visualize where at the highest level of returns and a given level of risk, where the highest Sharpe ratio lies. So we can copy whatever we have done so far here, all of this code to visualize that. We can paste it here. We can move this to the bottom. We can add one more code here by going plot.scatter. And let us introduce max Sharpe volatility and max Sharpe return. Okay. And then we can set the color here to be equal to, let's make this orange, and also here we can also set here so I haven't done that. We can let us run this code to see what happens here. So we can see here color, it's not really, we can see the orange color here, but it's let us add one more argument to this. Let us just add one more. Let's just say edge colors to be equal to black, or let us call that K is black. We run that code. As you can see here now, we can see that clearly here. So we can see where the highest Sharpe ratio lies within our return array, and where the highest Sharpe ratio lies within our volatility array, giving us our optimized portfolio. So the highest level of risks at a given level of returns. And as we said before, we have that as 1.96 of Sharpe ratio. So that's pretty much a very, very powerful to see in our model. So what we have done so far is very important. So we began by importing some packages from Python. We used imported NumPy as NP, pandas with the alias of PD, and matplotlib as PLT. We also imported yfinance as YF so we could download our full stocks. So we used the data frame, stock data frame, to assign our full stocks downloaded from Yahoo Finance. So we wanted to optimize our portfolio. That is assigning the highest investment value of each stock based on how much weighting we want to determine which of these stocks will be allocated the highest investment value. So we're able to use certain functions in Python. So we began here again by setting up the daily returns, that is the changes in the prices of each stock each day. And when we did that, we were able to establish here 10,000 different simulations. With 10,000 different simulations, we had here the weight array, which we had rows and columns. So for the rows, we had 10,000 different simulations, and we had 4 columns running. So 4 columns here, we have Apple, AMD, Microsoft, Oracle, and we use the len function here to return the value of each stock. So we were able to run that. As you can see, we had it here. So we did this because we had to fill this later one with numbers. So having done that, we also had our returns array, volatility array, and also we had our Sharpe array filled with zeros. Because later on we're gonna fill all of these later on with numbers. Remember, as I said before, we're gonna fill this with our weights, 4 random numbers from our random function. So we imported random, so we could fill this returns volatility array and Sharpe array with numbers, including our weight array. We also set up a random seed here for reproducibility, so that we can always obtain the same result each time we run this code block, or each time we run the entire model over and over again. And then here we set up for index in range, we set up a for loop here for each number and each weight 10,000 times. So what we're saying essentially here is that we had 4 random numbers, but we want that happening 10,000 times, and also for the weight, we have that also happening 10,000 times. So we have here the index in range within the simulations, and we also were able to set up here our returns array for each simulation, and we had that in place here. So we return our stock returns, taking the mean of the stock returns and multiplying it by 252 trading days in the year, and also multiplying that by our weights. So essentially we are filling all of these with numbers. That's essentially what we're doing here. So we are assigning these weights to our stock returns, and the average of the stock returns multiplied by 252 days, filling it with numbers and taking the sum of all of those. And for the volatility array, like I said before, it's an n times n matrix. So in this case, the nth matrix, that is for nth items within our portfolio, it means uncountable number of items. We use a 2x2 matrix to calculate the volatility of our portfolio. So as you can see here, we use the square root because this essentially is the variance. Okay, so the square root of the variance is the standard deviation. So the best measure of the volatility of our portfolio is our standard deviation of the portfolio. So like I said, the NumPy dot here is just multiplies a 2x2 matrix. So we have the weight here transposed. Remember, we determined this a while ago, and you saw that you were able to visualize that clearly. So we had here the weight transposed, and that was being transposed and multiplied with here the covariance of each stock within the portfolio, and then times 252 trading in the year, and of course filling this with numbers, because remember, with this weight here represents these random numbers here, which we weight each of those random numbers equal. So we were able to weigh those numbers, and that is why we have this weight here. So we are filling the entire numbers. However, we are assigning using the algorithm that before. In the real world, we have to take into account the risk-free rate. Since it was with So here we had here for the volatility array, like I said before, we took the square root of the variance. So the variance in this case, we have our weights being transposed because it's an n by n matrix. And we multiply that by the covariance of each stock within the portfolio. And of course, we assign the weights to that because the weights here are those random numbers. So we assign the weights to that, filling in whatever we had filled earlier with zeros. So we fill these weights with numbers. So we assign our weights, take into account our formula for the covariance of each stock within the portfolio, and then we take that matrix and we multiply that by the matrix of our weights here being transposed. So that's essentially what we are doing here. So we take the weights transposed, the random weights, we transpose that so that it should be in the same shape as our stock returns, so that they can be easy, so that they can be multiplied easily. So this matrix can be multiplied. So like we take this one by, it's gonna be 1 by 4. So we take 1 and we make sure we are multiplying it by our 4 columns matrix here for these stocks returns, or the covariance of our stock returns. So it's very, very easy to see here. It's just Python makes it a little bit complex. However, it is pretty much easy to see. So essentially, when you see weights, we are just assigning weights to our volatility array here for each simulation. So the weight here is just filling our volatility array here. So we are just replacing whatever we filled here with zeros. So we are filling this with weights. And then again, we are also assigning here. We are also assigning here. We have here our stock returns, the covariance of our stock returns in a year that is 252 trading days. That we multiply that by our weights matrix here, which we transpose so that we can easily multiply those together. So having done that, we were able to simulate our Sharpe array. The Sharpe array led us to determining the first Sharpe ratio within our portfolio. So the Sharpe array, like I said, is very important to understand that we take into account the risk-free rate of a government security such as a treasury bill or a government bond. In this case, since our security matures in 1 year, so we are taking into account the risk-free rate of a treasury bill if we have to include that in the reward. But we are just demonstrating how we can determine the Sharpe ratio of our portfolio. And of course, here we have the first combination of permutation. So we have here four different stocks. We can see here the different weights of those four stocks for our first simulation. So that's exactly what we see there. And then for the first simulation, we can see here the first Sharpe ratio of 1.26, and the Sharpe ratio greater than 1 tells us that our portfolio is performing better. However, we also have to determine here the highest Sharpe ratio in 10,000 different simulations. So in this case, we had the highest Sharpe ratio of 1.96 in 10,000 different simulations. And then here we had where the highest Sharpe ratio lied. So it lied in the first 1,499 simulations. That's essentially what we did there. And then here we printed out our stock list to further demonstrate our weights array with the highest Sharpe ratio. As you can see here, weights array, highest Sharpe ratio, that is the index marks, that is the highest Sharpe ratio, that is the rows, and then we have all of the columns here. And we can see that Apple stock was assigned the greatest weighting of 61%, followed by Oracle of 22%, followed by AMD of 14%, and lastly Microsoft of approximately 2%. So essentially what we are saying here is that if our investment value was $10,000, we'll be assigning 61% of stocks, and then we will assign 22% of 2% to Microsoft. And then here we were able to visualize what we did. We have 10,000 different simulations. Uh, and it should go on to see